Nobody thought this was possible, but it is true. The Federal Reserve is on the brink of bankruptcy. I'm going to explain this to you in one simple, fast step. Let's start by going over the fact that the Federal Reserve, the backbone of the global financial system, will be technically insolvent within weeks. And if you don't believe me, we're going to go to the Fed's balance sheet in a moment, and I'm going to prove it to you. But before we do, let's check out this chart. We go all the way back to 2010 to today's date. On the left, we go from negative 14 billion all the way up to a positive 6 billion. So starting off in around 2011, we see that the Federal Reserve was making a profit. How do we know this? Because technically they have to send their profits minus the 6% dividend they pay their owners, which are the banksters themselves, but that's a topic for a separate video. But they have to pay the excess profits to the Treasury. So you can see they're just humming right along, usually making about $2 billion payments to the Treasury. And all of a sudden, we get to about a month ago or 2 months ago, and what happens? The amount that the Fed sends the Treasury goes negative. In other words, they go from making money to losing massive amounts of money. To understand this better, editor, let's go right to the internet. Okay, here we are. This is the official website of your favorite central bank, the Federal Reserve. And before we go any further, I know a lot of you right now are saying, George, there's no way the Fed can be insolvent. They can print their own money. Yes, I get it. And we're going to get to that in just a moment. Let's get into this balance sheet. And these are the Fed's assets. So we've got about 8.6 trillion right now in assets. And this is as of December 8th, 2022. And you can see we've got things like treasuries, mortgage-backed securities, a little bit of gold, all the things that you would expect. But let's think this through. If the Fed is currently doing quantitative tightening, that means they're reducing the size of their balance sheet. They're letting a lot of these securities mature, and they're actually selling some of them, meaning they're selling some of the treasuries and selling some of the mortgage-backed securities. Now, if the Federal Reserve bought these at a lower interest rate, that means that they purchased them at a higher price, which also means that they're selling them at a loss, which is exactly what we saw on that chart of remittances to the Treasury back on the whiteboard. So if the Federal Reserve has to sell these securities at a loss, what that means is they have to reduce the asset side of their balance sheet more than the liability side of their balance sheet, which makes them insolvent. This is negative equity, but it gets a lot worse. Going back to those of you who are saying, well, the Fed can just print their own money. Well, yes, they can, but this makes them even more insolvent. If the Fed, quote unquote, prints money, just puts it in the reserve accounts of these banksters like Goldman Sachs, JP Morgan, Bank of America, etc., they are increasing the liability side of their balance sheet without increasing the asset side. So it just makes the matter worse. So then the question becomes, okay, George, well, how are they getting away with this? What are they doing to plug the hole that's being blown in their balance sheet? And this is where they come up with basically an accounting gimmick to make it seem like they're not insolvent. And it's called a deferred asset. So what that means is we're just going to give ourselves basically an IOU for future profits that we're going to make. So we're going to book future profits now as if they already exist. And therefore, this is going to make it seem to the general public who's not paying any attention that we aren't insolvent. And if we look at the current balance sheet, you can see so far they've done about 13 billion in these deferred asset accounting gimmicks, which would be indicated by this line item that says earnings remittances due to the United States Treasury. And for those of you who are really paying attention, you might say to yourself, okay, George, but I still don't see the big deal. Because let's just say the Fed did take the hit for the $13 billion. If they've got plenty of equity, it's not going to matter. And that's a very good point. So let's look at how much equity the Fed actually has. So for this, we look at the liability side of their balance sheet. And as far as I can tell, and the liability side of their balance sheet is pretty straightforward. It's right here, this line item that says other liabilities and capital. That would be $35 billion. Just keep in mind that only 2 or 3 months into quantitative tightening, they've had to take a loss of $13 billion. So like I said at the beginning of the video, they keep this up for another couple weeks, that $13 billion is going to exceed the $35 billion they have in capital and equity, which would make the Fed technically insolvent. But unfortunately, it gets worse. Let's think about something called IOR, interest on reserves. This is the interest rate the Fed pays the big banksters for holding their cash at the Fed. Just think about it exactly like your checking account with Wells Fargo, Bank of America, or Chase. And unless you've been living under a rock lately, you realize that the Fed is increasing interest rates. In fact, just this week, they're most likely going to go from 3.75 up to 4.25. What is this telling you? That is the interest rate, or close to the interest rate, the Fed is paying the banksters for keeping their cash at the Fed. So if that interest rate increases, just like any other bank, that means their expenses increase as well. Well, wait a minute here. The Fed is already losing money as a result of having to sell assets they have on their balance sheet at a lower price for quantitative tightening. That means that the loss the Fed is going to have to absorb is going to get even bigger the higher they raise interest rates and the longer they keep interest rates at those levels. So we're seeing a $13 billion loss now. I think that could easily go up to 50, 100 billion, or even more. And I know the naysayers are screaming at me, George, you're wearing a tinfoil hat again. What are you talking about? The Fed can take a loss. It doesn't matter. They're just part of the government. This is just crazy talk. Really? Well, for further insights as to whether this will matter, let's go right to a clip from an interview I just did with my good buddy and Fed insider, Joseph Wang. If you really wanted to get technical here, it takes them further and further and further into insolvency, if not for this little, I would call an accounting gimmick of a deferred asset.
Yeah, no, it's exactly right. It's an accounting gimmick. And, so central banks around the world handle this differently. Sometimes they actually have to go and get money from their government to pay for their operating losses. But here at the U.S., this is how it's done.
So I guess the next question would be, as someone who's worked at the Fed, and I'm sure you've maybe given this some thought, is there any limit to this account? Is there any limit? Do you think there's a point where the market sees this as like, wait a minute, whoa, time out here, $3 trillion in deferred assets? They're not going to make that much money. That's not possible. And then they realize that the Fed, just based on GAAP accounting, let's say, or the spirit of GAAP accounting, can't get back to positive equity. Does that even matter?
I think that's a really good big picture question. But I would actually, instead of focusing on the Fed just printing all this money to pay interest rate payments, I would also include what's happening with the U.S. government. They're just, spending $1 trillion in deficit every year, printing treasuries to pay for that. So from my perspective, I kind of lump that together. The Fed is printing money to pay interest rate payments. The federal government is printing treasuries to go and pay their purchases. Now, is there a point where the market can handle it, where people will start to realize that this is crazy, where this is not sustainable, and then we have this big moment where maybe we have tremendous concerns about inflation. Maybe we lose confidence in the debt market and people go and try to move their money elsewhere. Historically, that usually happens. I think maybe we are getting to a point in the coming years that may happen here as well. But what I hear from people in the markets and what I see in the market pricing, it seems like there's a lot of people who don't really realize that maybe there might be a fundamental regime shift as well. So as you suggest, that this is not sustainable and probably will probably bring some kind of disruption in the near to medium term.
And I'd like to remind you, my good buddy Joseph Wang not only worked at the Federal Reserve, he was in charge of the New York Fed's trading desk, which means he ran quantitative tightening and quantitative easing, which was the management system for the Fed's balance sheet. So if he's telling you it's not going to matter until it matters, you should listen. It goes right back to that old quote about going bankrupt. It happens very slowly and then all at once. The bottom line is, even if the Fed can make it seem like they're not bankrupt by this little accounting gimmick, they are bankrupt. And this is a risk that we should all be paying attention to.